I will be demonstrating how to solve for basic and diluted EPS. The problem reads, on January 1st, 2013, ISU Company had 400,000 common shares outstanding. This affects your denominator in that the entire amount will be added to the denominator because they were outstanding for the entire year. During 2013, ISU issued an additional 10,000 common shares on July 1st. These 10,000 common shares will also be added to the denominator, but additional issues of common shares are weighted for the amount of time they are outstanding for the year. They were outstanding from July 1st to the end of the year, and this is 6 out of the 12 months. 30,000 common shares were reacquired as treasury stock on October 1st. This 30,000 common shares will be subtracted from the denominator, but only for the amount of time they weren't outstanding. They weren't outstanding from October 1st to the end of the year. This is 3 out of the 12 months. ISU Company also had 20,000 shares of 8% $10 par cumulative preferred stock. Preferred stock dividends are subtracted from the numerator because only common stock is included in the EPS calculations. To calculate the amount of dividends you subtract off, you take the 20,000 shares multiplied by the $10 to get the value of the preferred shares. You then multiply this amount by the 8%. This gives you a 16,000 dividend to subtract from the numerator, essentially subtracting from net income. The only other information that affects the basic EPS is the fact that net income for 2013 was $560,000. This $560,000 will be added to the numerator. $560,000 minus $16,000 is $544,000 for the numerator. $4,000 plus $10,000 at 6 out of the 12 months minus $30,000 at 3 out of the 12 months is $397,500. $544,000 divided by $397,500 gives you a basic EPS of $1.37. Next, I am going to solve for diluted EPS. We will keep the equation for basic EPS but add some additional information. That additional information is that some options were granted in 2012 to purchase 5,000 shares of common stock at $8 per share. The average market price during 2013 was $10. No options were exercised during 2013. No options being exercised is telling us that the options will be converted into all of the 5,000 common shares. To determine how many shares to add to the denominator, we take the 5,000 shares at the $8 exercise price and get $40,000. Take that $40,000 divided by the $10 market price to get 4,000 shares being reacquired. The amount we would add to the denominator is the 5,000 minus the 4,000, so 1,000. The last bit of information reads, the 6% convertible bonds were issued in 2010 at face value of $300,000. The bonds will convert into common stock at 45 shares per 1,000 bond. The first thing we need to determine is how many shares will be added to the denominator. The problem reads, the bonds will convert into common stock at 45 shares per 1,000 bond. The face value is $300,000, so there are 300 $1,000 bonds. 300 multiplied by 45 shares gives us a total amount of 13,500 shares that are added to the denominator. The conversion of these bonds means that interest expense will not be paid out, so this money needs to be added back to net income after taxes have been subtracted. The face value of the bonds is $300,000. Multiply this by 6% to get $18,000 before taxes. The tax rate is 35%, so essentially we will be adding back 65% of the $18,000. $544,000, which was the basic EPS numerator, plus $11,700 is $555,700, and $397,500, which was the basic EPS denominator, plus $1,000 for the stock options and $13,500 for the convertible bonds, is $412,000, which gives us a diluted EPS of $1.35. We know that this is correct because the $1.35 is less than the basic EPS of $1.37. One other thing to note is that stocks, with the preferred stocks, is that if they had been convertible, we would add the additional shares to the denominator and we wouldn't subtract off the preferred dividends. Since the problem does not state that they are convertible, I will assume that they are non-convertible preferred shares.